Sustainable investing is evolving from niche strategy to mainstream expectation, and the coming years will be defined by a push from ambition to accountability. Investors are increasingly demanding measurable outcomes rather than labels, and that shift is reshaping product design, due diligence, and reporting. No longer satisfied with broad ESG claims, asset owners want clear links between capital allocation and real world impacts such as emissions reductions, biodiversity restoration, or improved livelihoods. This demand for transparency is driving greater standardization around metrics, more rigorous third party verification, and a premium on strategies that can demonstrate credible pathways to agreed targets like net zero. Climate considerations will remain central, but the focus is broadening. While decarbonization and climate risk analysis dominated early sustainable investing narratives, attention is expanding to nature-related risks, water security, and supply chain resilience. The emergence of frameworks such as nature-related financial disclosures and stronger scrutiny of biodiversity impacts will push investors to integrate ecological dependencies into valuation models. At the same time, social factors, worker rights, community impacts, equitable transitions, are gaining traction as investors recognize that durable returns depend on social as well as environmental stability. Technology and data will be critical enablers of this next phase. Advances in remote sensing, alternative data, AI-driven analytics, and blockchain for traceability are making it easier to monitor corporate practices, verify claims, and assess outcomes at scale. Better data lowers the cost of measuring impact and enables more dynamic portfolio management in response to evolving risks. However, the quality and comparability of data remain challenges. Investors will continue to demand improved disclosure standards and harmonized reporting to avoid fragmentation and greenwashing. Product innovation will accelerate along multiple fronts: green and sustainability-linked bonds, blended finance structures that combine public and private capital, and dedicated transition funds for high-emitting sectors are likely to proliferate. Private markets, infrastructure, real assets, and private equity will attract growing ESG capital as investors seek long-term, tangible avenues for impact. Meanwhile, stewardship and active engagement will be recognized as core tools. Investors who engage with companies to improve practices may unlock value more effectively than those who rely solely on exclusionary screening. Regulation and policy will be powerful forces shaping the landscape. Jurisdictions are moving toward mandatory climate and sustainability disclosures, stricter fiduciary guidance, and rules around product labeling. These changes will raise baseline expectations and encourage a race to higher quality offerings. At the same time, geopolitical dynamics and differing regional standards will require investors to navigate a complex, evolving compliance environment, balancing global best practices with local nuances. Ultimately, the future of sustainable investing will be defined by integration and outcomes, where environmental, social, and governance considerations are embedded across investment processes, and where success is measured in tangible progress towards sustainability goals. Investors who combine rigorous data, thoughtful engagement, creative finance structures, and a long-term outlook will be best positioned to deliver both competitive returns and meaningful impact as the market matures.